Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the penultimate installment of our mini-series around our H2 outlook. Yesterday I spoke to Fuqian about the opportunities and risks facing investors in equity markets. Today I want to focus on the outlook for currency markets, and to do this I have asked Manpreet Gill, who needs no introduction for regular listeners of his daily Cut to the Chase podcast, to join me. The first half of the year has been dominated by US dollar strength. Today we will discuss whether this is likely to continue and also the outlook for the euro, yen and commodity currencies. Before we start, I wanted to just flag that we're having a live webinar on Monday, July 4th. This event includes a fireside chat with Professor Raghuram Rajan, who is a former IMF chief economist and former Reserve Bank of India governor. And we will discuss the long-term outlook for inflation, key financial imbalances we should be worried about, the regulatory outlook for cryptocurrencies, and also the future of India and China. Obviously, you'll also hear from Standard Chartered CIO Office on how you might position your portfolios given the opportunities and risks facing investors going into the second half of the year. Attendees will also get the chance to ask questions to all the speakers. If you're interested in registering for the event, you can do so at www.sc.com/GMO or Global Market Outlook, or just click the link in the description of the podcast. With that, let's get started and talk about the outlook for currencies. So Manpreet, let's start with the short-term outlook. I guess the strength of the US dollar has surprised us so far this year. Has it got further to go?
Hi, Steve. I think that, yes, the dollar's certainly been unusually strong for a large part of this year. But when we take sort of a short-term outlook, looking out over the next few weeks or indeed over the next 1 to 3 months, there is a risk we see that the dollar stays in a range or potentially even strengthens a little bit further. And, our long-term views, of course, on the dollar notwithstanding, I think there are two reasons why we do hold that view, besides, of course, strong momentum and the nature for currencies to overshoot. First is, of course, what we're seeing from the central banks. I think while a lot of rate hikes are priced in, for the Fed, I think we've seen a consistent stream of hawkish messaging from the Fed, while messaging from the ECB in terms of the interest rate hiking cycle has not quite caught up in terms of its level of hawkishness. So I think that's one factor, together with an extremely dovish Bank of Japan, of course, that sort of been supporting the dollar. And the second, of course, is demand for safe havens. I think we've seen a fair amount of risk aversion persist through a large part of the year so far, and that, of course, continues to offer at least some level of support for the dollar. So I think unless we see a significant change in either of those drivers, there's a risk that what we're seeing currently in terms of a range-bound dollar with clearly still a strong upward bias, that's likely to persist unless either of those two factors change. And that's why even though we're bearish on the dollar long-term, on a shorter 1 to 3 month horizon, we retain a more neutral view, clearly with more of a bullish bias. I would highlight that on the DXY dollar index, I think 105.8 is really the key level to watch in the short term, because that has been the most recent peak that's capped the dollar index for now. And I think if that does hold, I think that'll help support the view that the dollar index, of course, is staying in the range and just testing those levels. But of course, a more sustained break above that could extend the short-term bullishness for the short term at least.
Okay, so you sort of hinted at the dollar weakness views holding for the 6 to 12-month outlook. So can you give some indication as to where euro might be trading in 12 months or so?
Well, in the euro, I think we could see quite a mirror image of what we expect on the dollar. So I think our view on the pair is that we do end up seeing it go to above to 1.08 or potentially even a little bit higher in 12 months' time. But a lot of that, of course, is just the dollar view. So you think on the US dollar, for example, we do expect, like I said, for the dollar to be weaker 12 months, because when you start looking out 12 months, then you're really talking about both what relative interest rates are likely to look like, and of course, what we see on the European side as well. So our expectation 12 months, of course, is that the hawkish Fed cycle is largely in the price, but there's quite a bit of room for expectations on the European side, or even on the Japanese side at a stretch, should yield curve control not continue, for those to catch up. And I think that, combined with expensive valuations on the dollar side, is what caused us to have that bearish view. And the euro dollar, of course, it's close to 2/3 of the dollar of the DXY index, just under 60%. So that, of course, we expect will be to a large degree a mirror image of that. And what that means in the short term, we could see a test, of course, of 1.034 support, given a short term view on the dollar. But 12 months out, of course, looking for 1.08 or potentially even a little bit more than that.
Okay, so that's the euro. So in terms of elsewhere, where do you see the biggest opportunities, in terms of buying currencies against the dollar? Obviously, timing is important, but where do you see the biggest opportunities going forward?
Well, in terms of opportunities to go long currencies, I think the biggest opportunity in our view still sits in commodity currencies. And there are really two reasons for that. I think one is one group of currencies that continue to display quite a large gap with where commodity prices are. And that's something we can see in their sort of terms of trade, where export prices of commodities have continued to rise quite a bit this year. And second is that in today's environment, where there's a lot of concern about Fed rate hikes, these are a pool of currencies that are being supported by their own rate hikes, by their own central banks in today's rate sensitive world. Now, from amongst the big three, I call them the Aussie, the Kiwi, and the Loonie. Arguably, the Aussie dollar has the most room to catch up on both of those drivers. And if we do see an ongoing rebound in China's economy, as we expect, I think that, if anything, can add further upside to that view. And the Canadian dollar, of course, being quite interesting because it's more correlated to oil prices, which, of course, are at the center of many concerns on the inflation and central bank side today. So I think between the group, I think those are two that do stand out even within that on a relative basis. And of course, in terms of levels, when we're looking out 12 months for the Aussie dollar, we do expect to move to about 73 cents against the US dollar, and for the dollar CAD pair, a move lower toward 1.25. So on the long side, I think that's the opportunity which really stands out. There's, of course, often questions asked about, whether opportunities on the funding currency side. Here, of course, I'd be a little bit more careful. I think it's always important to by and large, try and match assets and liabilities as far as possible. And if you're going to deviate from that, keep those short-term in nature with good risk control. But if we had to take any such short-term bets, of course, I think it's the euros where we'd really do that. And that it fits into the short-term conversation we had earlier.
I guess that's a great segue into what I was going to talk about next, which is obviously the yen. So no conversation about currency markets today would be complete without talking about dollar yen, given the size of the move we've seen so far. Clearly it looks extremely stretched. But then again, we could have been talking exactly the same conversation last month. So how high can dollar yen go? I mean, 147 is the highest level we've been for, on a multi-decade basis. Can we get back there?
Well, you certainly can't rule it out. It's like you said. I mean, it's a conversation we could have had. It's identical conversation a month ago, just a very different level of Japanese yen. But I think more seriously, I think the key point here is that as long as we get this extreme divergence between the Fed continuing to harp on its hawkish message on one side and the Bank of Japan sticking to its yield curve control line on the other, it does look likely that dollar yen will continue to grind higher. And I think record highs notwithstanding, I think on a more foreseeable horizon, we'd really look towards 139 to 140 as the more plausible outcomes on a shorter horizon. But I think that what makes investing in the yen quite challenging is that, as you mentioned, positioning is one-sided. So what that means is, if any of those conditions change, the risk of a snapback, and a very large one at that, is potentially very, very large. And of course, you could argue that happens because the Fed sort of either steps back from its extreme messaging, or we get some sort of unexpected outcome from the Bank of Japan in terms of its existing yield curve control policy, or even that policymakers follow through at some point in terms of intervention in FX markets. And all of these, at the end of the day, create large risks, in our view, of moves in both directions. And where that leaves us, of course, is when you end up with the possibility of such large moves. I mean, our own 12-month forecast is 126 now in 6 to 12 months' time. In our view, that just leaves us with a very poor risk reward on this currency pair alone. So quite a wide range of outcomes. I think as long as current policy messaging persists, it's higher for the pair. But I think we just need to consciously be on watch for an equally large move on the downside should some factor change. And that's why when it comes to directional trades, at least, we just think it makes for better risk reward to look elsewhere rather than just on the yen.
Yeah, and I guess the Japanese authorities are, and the central bank in particular, is under some pressure at the moment. So it'll be interesting to see how they react to that. Okay, finally, not really a currency. Some people treat it as a currency, but I think we should talk a little bit about gold. So obviously talking to Audrey about this last week, but can you give a sense of likely trajectory over the next 6 to 12 months in terms of levels for gold price?
Sure. I think on the gold, I think when we look at the short term of the next 1 to 3 months, I think it's quite possible that we spend some time in a range. I think the key levels around that are about 1775 on the downside and 1875 on the top, because I think that sort of fits in with our view on some of the key drivers as well. I think it's been quite remarkable, of course, that gold has held up quite well despite higher bond yields and a stronger dollar, both of which would have normally pointed to much lower gold prices. But I think if we're getting sort of yields being range bound, of course, still testing an upside bias, and the dollar, of course, potentially being higher in the short term, I think those are what are likely to keep gold in some degree of a range, at least over the next 1 to 3 months. Unless, of course, we get a risk-off episode, in which case we know gold does perform well in the short term as a risk hedge. Longer term, though, I think it's still reasonable to expect prices to grind higher towards $1,960. And I think in the previous cycle, of course, our view on falling bond yields was a key driver of gold. But I think in this cycle, we really expect that turn lower in the US dollar to be the key driver and really pick up where bond yields left off. And I think the last point I'd make is that from a portfolio perspective, of course, inflation is, of course, the main risk today. And I think that's where gold also has some demonstrated impact as one potential inflation hedge as well. So that combination, we think, still does make it quite attractive when you're taking a 6 to 12 month view.
Okay, thanks, Manpreet, and thank you, listener, for joining us today. Tomorrow, I will be talking to Hannah Chu about how a multi-asset income investor might approach the current investment climate. Just as a reminder, if you'd like to sign up to our H2 Global Market Outlook webinar, please click the link in the description. In the meantime, please take care and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.